China just made a move that changes everything, not in the South China Sea, not in trade negotiations, not in technology competition, in gold markets. And what they did this week will force every central bank, every government, every major financial institution to choose sides in a monetary war that has already begun. Ladies and gentlemen, I need you to understand what happened on Thursday morning, Beijing time. The People's Bank of China, working through the Shanghai Gold Exchange, announced the launch of what they're calling the Global Physical Gold Settlement Network. But that technical name doesn't capture the magnitude of what they just unleashed on the global financial system. Here's what they actually did. China just created a parallel gold trading system that bypasses every Western financial institution, every dollar-denominated market, every traditional precious metals exchange. They built the infrastructure for nations to trade gold directly, settle payments in gold, and conduct international commerce using physical metal instead of paper currencies. But that's not the shocking part. The shocking part is who signed up. In less than 72 hours after the announcement, 37 nations committed to participating in the Chinese gold network. Not just allies, not just developing countries, major economies that have been integrated into Western financial systems for decades. Russia was expected. Iran was predictable. But when Saudi Arabia, the UAE, Brazil, India, South Africa, Indonesia, Malaysia, Thailand, and Turkey all announced their participation within the same week, the geopolitical implications became clear. China just assembled a gold-backed alternative to the dollar system, and it includes countries representing over 60% of global GDP. The Saudi announcement was particularly devastating to Western monetary control. Crown Prince Mohammed bin Salman personally endorsed the gold network during a televised ceremony in Riyadh, stating that the kingdom would begin accepting gold settlements for oil sales to participating nations within 90 days. When the world's largest oil exporter officially abandons the petrodollar system, the foundation of American monetary dominance cracks audibly. The United Arab Emirates followed with an even more aggressive commitment. Dubai's financial authorities announced they would establish the Middle East's largest gold storage and settlement facility, capable of handling over 10,000 tons of physical metal. They're positioning to become the regional hub for China's network, competing directly with London's traditional role in global gold markets. Brazil's participation surprised Western analysts, who expected Latin American resistance to Chinese monetary influence. But President Lula da Silva announced that Brazil would use gold settlements for all soybean and iron ore exports to China, representing over $40 billion in annual trade that will bypass the dollar system entirely. India's decision created the most immediate market impact. The Reserve Bank of India committed to converting 20% of their foreign exchange reserves from dollars to gold certificates in the Chinese network over 18 months. When the world's largest gold consumer officially endorses China's system, global demand dynamics shift permanently. The mechanism is elegant and devastating to Western monetary control. Participating nations deposit physical gold into secure storage facilities managed by the Shanghai Gold Exchange. They receive digital certificates representing exact quantities of physical metal. These certificates can be transferred instantly between central banks, corporations, or governments to settle trade balances, commodity purchases, or debt obligations. Think about what this means. A country like India can now buy oil from Russia, pay with gold certificates backed by actual metal stored in Shanghai, without touching the dollar system, without using Western banks, without any exposure to American sanctions or European financial regulations. China just made Western monetary control optional instead of mandatory. The timing isn't coincidental. This gold network launched exactly 1 week after Western central banks coordinated their emergency interventions in silver markets. Exactly 2 weeks after major Western banks announced their shift toward physical asset backing. Exactly 1 month after institutional money began fleeing traditional paper assets. China watched the West's financial system show signs of stress and decided to accelerate the timeline for dollar replacement. They didn't wait for the next crisis. They created the alternative while Western institutions were distracted by their own internal contradictions. But the most brilliant aspect of China's strategy is how they solved the trust problem that has prevented previous alternative monetary systems from succeeding. Other countries don't have to trust Chinese currency. They don't have to trust Chinese government promises. They only have to trust that gold is gold and that the Shanghai Gold Exchange can accurately weigh and store physical metal. By building their system around physical gold rather than yuan-denominated digital payments, China eliminated the credibility issues that limited previous attempts to challenge dollar dominance. Gold has been trusted as a store of value for 5,000 years across every culture, every empire, every monetary system. No one questions whether gold will be valuable tomorrow. The Western response has been swift and panicked. Within 24 hours of China's announcement, Federal Reserve officials held emergency conference calls with European central bank governors, Bank of England executives, and Bank of Japan leadership. Internal communications, leaked through congressional banking oversight processes, show Western central bankers discussing what they call containment strategies. The Federal Reserve's internal strategy documents reveal 3 potential response options, none of them encouraging. Option 1, attempt to crash gold prices through massive paper gold sales on Western exchanges, risking the destruction of American gold mining companies and validation of China's claims about Western market manipulation. Option 2, create a competing Western gold settlement network, requiring unprecedented coordination between nations that can't agree on basic monetary policy. Option 3, accept the transition and attempt to negotiate favorable terms for American participation in China's system. Federal Reserve Chair Jerome Powell reportedly favors option 3, understanding that fighting China's gold network directly would accelerate the dollar's decline. But Treasury Secretary Yellen and Defense Secretary Austin are pushing for more aggressive responses, viewing China's monetary challenge as a national security threat requiring economic warfare rather than financial accommodation. The European Central Bank faces different but equally difficult choices. ECB President Christine Lagarde has been conducting quiet negotiations with Chinese monetary authorities about potential European participation in the gold network, while simultaneously coordinating with the Federal Reserve on containment strategies. European central bankers understand they cannot afford to be excluded from both American and Chinese monetary systems. The Federal Reserve's immediate concern isn't the loss of individual transactions, it's the precedent. If major oil-producing nations can sell energy for gold instead of dollars, if major manufacturing economies can buy commodities with gold instead of dollars, if large populations can conduct international commerce without dollars, then dollar demand collapses structurally, not cyclically. The European Central Bank faces an even more complex challenge. European nations depend heavily on Chinese manufacturing and Russian energy. If those trade relationships can be conducted through China's gold network, European countries face pressure to choose between maintaining transatlantic financial integration or accessing the resources they need for economic survival. Japan's position is particularly precarious. Their economy depends on importing raw materials and energy, while exporting manufactured goods to China and throughout Asia. If their major trading partners shift to gold-based settlement systems, Japan must either join the Chinese network or watch their economic relationships deteriorate. But the most telling response came from an unexpected source. The Bank for International Settlements, the central bank of central banks, issued an emergency research note warning about what they called systematic monetary fragmentation. When the institution that coordinates global central bank policy starts warning about systematic fragmentation, the system is already fragmenting. The gold markets themselves are responding exactly as you'd expect. Physical gold prices have disconnected from paper gold futures in ways not seen since the London gold pool collapse in 1968. The Shanghai Gold Exchange is trading at premiums of $15 to $20 per ounce above New York and London markets, creating arbitrage opportunities that can't be exploited because the metal is flowing toward the Chinese system, not away from it. Gold mining companies are receiving unprecedented demand from central banks and sovereign wealth funds seeking to secure future production. But the demand isn't coming from traditional Western buyers. It's coming from participants in China's new network who understand they need physical metal to back their participation in the post-dollar trading system. The transformation of the mining industry is happening with stunning speed. Barrick Gold, the world's second largest gold producer, announced this week that over 60% of their 2026 production has already been contracted to central banks participating in China's network. They're not selling gold to commodity traders or jewelry manufacturers anymore. They're selling directly to sovereign entities building strategic reserves. Newmont Corporation, America's largest gold producer, faces a strategic crisis. Their Nevada operations could supply physical backing for American participation in global gold networks, but current U.S. policy prevents them from dealing directly with Chinese monetary authorities. They're caught between serving American strategic interests and maximizing shareholder value in a rapidly changing market. African gold producers are experiencing the most dramatic impacts. Ghana, Mali, Burkina Faso, all major producers working through Chinese-controlled mining operations, have committed their entire 2026 output to China's settlement network. They're not just selling gold to China, they're essentially backing their national economic strategies with their mineral wealth. Canadian mining companies face unique pressures as American allies operating in a North American integrated economy, but competing globally against Chinese-backed operations that offer premium pricing for strategic metal supplies. Several major Canadian producers are quietly exploring joint ventures with Chinese entities to access the gold network while maintaining political relationships with the United States. The implications for currency markets are staggering. As countries begin settling trade balances through gold transfers instead of currency exchanges, demand for dollars, euros, yen, and pounds decreases. Not gradually, but systematically. as entire categories of international transactions shift to gold-based settlement. Currency traders are reporting unprecedented volatility in emerging market currencies as nations position for transition to gold-based systems. The Turkish lira, Brazilian real, South African rand, all experiencing massive fluctuations as markets price in reduced dependence on traditional Western currency relationships. But the most shocking development is happening in currency forward markets. Major international corporations are canceling multi-billion-dollar currency hedging contracts, choosing instead to accept delivery risk rather than continue paying for protection against currency fluctuations they expect to become irrelevant. Unilever, the British-Dutch consumer goods giant, announced this week they would cease hedging currency exposure for transactions with China and other gold network participants. They're essentially betting that gold-based settlements will eliminate currency risk more effectively than traditional financial hedging strategies. Mercedes-Benz and BMW, German automotive exporters heavily dependent on Chinese markets, are restructuring their Chinese operations to accept gold-based payments for luxury vehicle sales. When premium European manufacturers start accepting gold instead of yuan or dollars, the currency system transition becomes operational rather than theoretical. Oil markets are experiencing the early stages of historic repricing. Several Organization of Petroleum Exporting Countries members are reportedly discussing pricing oil in gold weights rather than dollar values. When oil, the most important globally traded commodity, starts being priced in gold instead of dollars, the entire foundation of modern monetary systems shifts. But China's gold strategy goes much deeper than creating an alternative payment network. Intelligence reports from Western defense agencies suggest China has been systematically accumulating physical gold through multiple channels for over a decade, building reserves that dwarf official central bank holdings. The People's Bank of China officially reports holding approximately 2,000 tons of gold in central bank reserves. But industry analysis of mining production, import data, and private accumulation suggests China's total national gold holdings, including government stockpiles, state-owned enterprises, and encouraged private investment, exceed 20,000 tons. If accurate, that would make China the largest holder of gold in world history, controlling nearly 10% of all gold ever mined by humanity. Such massive holdings would give China the ability to influence global gold markets, stabilize their new settlement network against manipulation attempts, and provide backing for international trade volumes that exceed current precious metals markets. Chinese state-owned enterprises have been quietly acquiring gold mining operations across Africa, South America, and Central Asia, not as investments, but as strategic assets to secure future gold production for their monetary system. They're building vertical integration from mining to storage to international settlement. The Belt and Road Initiative, China's massive infrastructure investment program, is being restructured to accept gold-based payments and settlement. Countries participating in Chinese-funded development projects can now pay for infrastructure using gold deposits in Shanghai rather than taking on dollar-denominated debt obligations. This creates a powerful incentive system. Developing nations can access Chinese investment capital, Chinese technology, and Chinese markets by participating in the gold network. Or they can remain dependent on Western financial systems that require dollar borrowing, Western bank intermediation, and exposure to American monetary policy. China is offering the developing world something the West never could: an escape from dollar dependence that doesn't require trusting another nation's currency. Countries joining China's gold network aren't replacing dollar dependence with yuan dependence. They're replacing currency dependence with physical asset dependence. The timing advantage China has achieved is enormous. While Western central banks spent decades building systems based on fiat currency management, debt creation, and paper asset manipulation, China quietly built systems based on physical asset accumulation, production capacity, and real wealth creation. Now that Western systems are showing structural stress, China can offer fully operational alternatives backed by physical assets rather than government promises. They're not proposing future solutions to current problems. They're implementing present solutions to inevitable problems. American foreign policy establishment is struggling to develop effective responses to China's gold strategy because traditional tools of economic statecraft depend on dollar dominance. Sanctions, financial isolation, banking restrictions all lose effectiveness when target nations can conduct commerce through physical asset networks. Military responses to economic competition seem disproportionate and counterproductive. Starting conflicts to prevent countries from trading gold creates international opposition and accelerates the search for alternatives to Western-dominated systems. Diplomatic pressure faces similar limitations. China isn't asking other nations to choose between East and West. They're offering practical solutions to immediate problems: how to conduct international trade without exposure to currency fluctuations, how to protect national reserves from external manipulation, how to access Chinese markets and technology without political complications. The most troubling aspect of China's gold strategy from a Western perspective is its irreversibility. Once nations begin conducting significant portions of their international trade through physical asset settlement, they develop infrastructure, relationships, and institutional knowledge that create switching costs for returning to dollar-based systems. Financial infrastructure is path-dependent. The first-mover advantage in establishing alternative monetary networks creates network effects that become stronger over time. As more nations join China's gold system, it becomes more valuable for other nations to join, creating a virtuous cycle for participants and a vicious cycle for non-participants. The wealth transfer implications are historic. For 70 years, dollar dominance allowed the United States to export inflation, import goods at below market prices, and finance government deficits through foreign central bank purchases of treasury bonds. As nations shift to gold-based trade settlement, those advantages disappear. China's gold strategy doesn't just challenge American monetary supremacy, it challenges the entire post-World War II international economic order, built around Western financial institutions, dollar-denominated trade, and American economic leadership. The European Union faces existential questions about their relationship with both China and the United States. European nations need Chinese manufacturing and technology, but they also need American security guarantees and market access. China's gold network offers economic benefits while potentially creating political complications. Japan and South Korea, America's closest Asian allies, face similar dilemmas multiplied by geographic proximity to China and deeper economic integration with Chinese supply chains. They must choose between political alignment with the United States and economic optimization through Chinese gold networks. The developing world faces no such dilemmas. China's gold system offers them access to the world's largest manufacturing economy, the world's largest consumer market, and the world's most extensive infrastructure investment program, all without the political conditions traditionally attached to Western economic integration. For individual nations, joining China's gold network represents a rational response to changing global economic realities. But collectively, those individual rational decisions are creating a new global monetary order that relegates Western currencies to regional rather than international roles. The transformation isn't happening through dramatic market crashes or geopolitical conflicts. It's happening through quiet, practical decisions by central banks, corporations, and governments who recognize that China's gold-backed alternative offers superior stability, lower costs, and reduced political risk compared to traditional Western financial systems. China's latest gold play isn't just rewriting the global financial order. It's demonstrating that the global financial order was always temporary, always dependent on American economic supremacy, always vulnerable to practical alternatives backed by physical assets rather than political promises. The question isn't whether China's gold strategy will succeed. The question is how quickly other nations will recognize that joining the Chinese system offers them better prospects than defending a Western system that no longer serves their interests. The rewriting has already begun. The only choice left is which system to write the future in, paper or gold.